There we go. Waiting on
Jim, we are looking for you.
There we go. There we go. All right. Well, thanks, Scott and Bill, and we'll talk to you guys in a little bit.
Sounds good. Our pleasure. Take care, guys.
Thank you.
Well,
All right.
thank you, Todd. Can you hear me okay?
Yeah, perfectly. And I got a text from Mr. Jeff Johnson that said, "Hey, ask Jim about 1031. What's his opinion?" So
I have
got
to
to throw that out there.
I have an opinion. I don't think it's going to go away. So that's my opinion.
Done. Boom.
Jim's opinion is all that matters, so we're good.
I don't know. Here's the reason why. So the 1031 was enacted to help protect the family farmer, right? Way back when. And it's always been around. And I don't think that'll change. I look at all the people in Congress that own real estate, and they own a lot. And I'm sure they've used 1031. I just don't think it's going to go away. Yes,
the revenue raised from doing some of these things is minimal, right? I mean, they need big impact items.
Oh, it would be costly. Think of all the deals that wouldn't get done, all the people that would lose. Yeah, no, it's the revenue impact on that would be tremendous. Yeah, I think it'd be counterproductive. So,
well, I'll let you go, Jim. You're moderating. Let me know if you need anything. I'll be here in the background. Do you guys need slides? Did I see something about slides?
We do have slides. So
Okay,
should I share my screen?
You should.
Perfect.
Gotcha. I can probably, when it comes up to me, I could share my screen so I can kind of navigate through a little bit, you know.
Holler at me if you have issues. I'll be here listening.
Okay. So why don't we, hey, there's Steve. So why don't we start with some intros and then we'll get going. My name is Jim Lockhart. I lead Wipfli's real estate practice firm-wide. I live in Minneapolis, spend a fair amount of my time in Chicago. But anyways, we have a really great group. Some of our best and brightest are here today to talk about PPP, the CARES Act, cost seg, and the tax outlook for 2021. So that's my brief intro. Dannielle, do you want to give yourself a brief intro?
Sure. Yeah. Thanks, Jim. So good morning, or I guess at this point, afternoon, everyone. I'm Dannielle Lewis. I'm a senior tax manager at Wipfli. I lead our opportunity zone group for the firm and also work in our real estate group pretty heavily. So happy to work with all the guys on this panel quite a bit. Josh, I'll roll to you.
Awesome. Thank you. And can you see the screen or the slides appropriately? Perfect. Just want to make sure. Thank you, Dannielle. I am Josh Graham. I am a tax partner out of our Chicago office. I very heavily focus on our construction and real estate practice and help lead our tax practice, our CRE practice in Chicago. I work very closely with Dannielle and Jim on our Opportunity Zone team nationally. We work with Steve a lot with cost segregations and energy credits, which we'll talk about, and just spend a lot of time thinking about tax planning strategies and how we can help save our clients some money. With that, I will hand it over to Steve.
Hello, everybody. I'm Stephen Barnes. I'm a senior manager here at Wipfli. I lead our cost segregation and energy tax incentives. I guess I point out that I'm not a CPA. Got to back away from these guys. My background is in architecture and construction, specifically related to the services that we're providing, with these type of energy credits and deductions that you can receive. And then cost segregation, where it involves construction and how buildings are constructed and how you depreciate those buildings.
Okay, great. So Josh, do you just want to give a brief intro into the CARES Act real quick?
Yeah. One of the topics that we wanted to touch on was the CARES Act, and this was enacted at the end of March, obviously due to COVID, and was a way to provide both tax and non-tax provisions to support businesses and individuals impacted by COVID-19. And there are a lot of positive impacts on the construction and real estate industry as it relates to the CARES Act I'm going to go through some of the tax stuff, income tax stuff in a minute, but before we do that, there was also some big emergency funding known as the Paycheck Protection Program as part of the CARES Act, and I'm going to have Jim share some thoughts on that.
Well, you're right. We've all participated in or attended a number of webinars on the PPP loans. Right now, the big deal people are focused on is forgiveness. And, what does that look like from a tax perspective? The IRS came out with notice 2020-32, where they said if the amount of your loan gets forgiven, the expenses attributed to those funds are not deductible. We've all been kind of waiting and hoping that there'd be, some better guidance on that said, hey, not only do you not have to pick it up, but you can still deduct the expenses. And, we've heard some people say, well, wait till 2021, get it forgiven, but take the expense in 2020. The IRS is aware of that strategy. So, we're hoping that we get some guidance out, sooner rather than later. I know a number of banks that are saying, hey, just, hold off on the forgiveness part, until later. So, it's up to everybody to talk to their tax advisor on that. But the current position for the IRS is that the expenses are not deductible to the extent that it's forgiven. So we're crossing our fingers and hoping, that, position gets reversed.
And the only thing I'll add to that, Jim, is if there is a reversal of that position in the future, I would think that it's going to apply to your PPP loan forgiveness regardless of when you were actually forgiven.
Right.
If it was in 2020 or in 2021. So the strategy to wait is a questionable strategy, I would say.
Right. I would say so too. Right. It's, we've seen legislation that gets passed in the subsequent year for the prior year, and that's what would probably happen here anyways. So, right. So, hopefully we see something soon.
Agreed. That would be best case, that we all just find out what's going to happen sooner than later.
Right. Yeah, but it's Congress.
That will take the government working together.
All right.
So
Well, I'm
we'll
going
hope
to
for that.
hand the ball back to you then.
Okay, with that, want to briefly touch on some of the changes that occurred to the tax law with the CARES Act and just earlier in the year. There were some big changes that could be very beneficial to people in the construction and real estate industry. Two of those changes relate to net operating losses and excess business losses. Very similar concepts, but back when the tax law was changed with the TCJA, the Tax Cuts and Jobs Act, back at the end of 2017, there was actually a limitation on being able to utilize losses if you generated them, whereas you could only carry them forward on an ongoing basis. And even when you did carry them forward, they would be limited to 80% of your income in any given year, meaning that you were likely going to be a taxpayer if you did have taxable income in future years. There was also a limitation that they put in place known as excess business losses. And these are for non-corporate owners. So if you're either like an owner of a partnership or if you're a sole proprietor and report something under Schedule C, there was a limitation on the losses that you could utilize in any given year. If you're married filing joint, that limit was 500,000. If you're single, it was 250,000. But essentially what this meant was you could only utilize that big of a loss, no matter how big of a loss you had from your investments. And anything on top of that would get carried forward, converted to an NOL, and then fall into the same NOL limitations. So it wasn't all that favorable when they made the tax law change. So then fast forward to the CARES Act that occurred, COVID relief in mid 2020, and they have relieved some of the limitations on the NOLs through the 2020 tax year. And so what the tax law did was, for any losses that were generated in tax years 2018, 2019, or 20, you could now utilize those and carry them back up to 5 years again to go and get cash immediately. It was a way to get cash back into the taxpayers' pockets. And also that limitation to 80% of your income also was removed for losses that were generated in those 3 years. On top of that, they got rid of the excess business loss limitations for those 3 years as well, meaning if you are generating a lot of losses, and all this will mean more in hopefully 2 minutes, if you are able to generate a lot of losses that are non-corporate losses, there isn't that limitation, and you could actually utilize them to the extent there isn't something that would prevent you from doing that, to offset your other income. And you could actually convert it to an NOL and carry it back. So there are some big changes to the tax law that occurred. And one last thing before I go through this example, they also finally corrected the definition of qualified improvement property. And so qualified improvement property is generally improvements that are made to non-residential property, like after the property is placed in service, internal improvements. When they made the tax law change back at the end of 17, the qualified improvement property didn't qualify for bonus depreciation and had to be essentially depreciated over 39 years. They have now corrected that that definition, and anything that qualifies as qualified improvement property is now depreciable over 15 years and qualifies for 100% bonus depreciation.
I'll be done soon.
Which means that you can generate very large losses that could turn into NOLs that you can utilize to either get back taxes that you paid previously or utilize going forward. And that's what this example is now showing in front of you. So this is an example of a real estate professional for tax purposes. So in order to, there are certain requirements that need to be met to be considered a real estate professional. But if you do meet those requirements and you have losses from rental real estate, those losses can be likely treated as non-passive, which means that they could be utilized to offset your ordinary income, your wages, your commissions. And so that's what this is showing, as if those losses are treated as non-passive. But so we'll start at the top of the screen. And this is showing before the CARES Act, there would have been NOL generated of a little over $1.4 million, and that would have needed to be carried forward and would have been limited. After the CARES Act and the change to the qualified improvement property definition, you can see that there's over $1 million more of rental losses. And this is a real life example of one of our clients, where because of the change to qualified improvement property, they were able to get an additional $1.2 almost $1 million of deductions immediately in 2019 from that tax law change. So that essentially increased their NOL to 2.6 million. And then because of the excess business loss limitation relief and the ability to carry back those NOLs, this is actually showing that our client was able to carry back the 2.6 million and generate refunds of just under $800,000 of taxes that they had paid previously and get that refunded. And another benefit of carrying it back 5 years is that those tax rates were higher 5 years ago than they are starting in 18 because of the TCJA, the tax law change. So it's actually more valuable to be able to carry it back to those earlier years. So I wanted to provide that kind of at a high level. Hopefully it wasn't too tax technical. But with that, want to throw it over to Steve Barnes, who is our cost segregation expert, to talk about how you can get some of these losses and to talk about some other good tax savings topics.
Certainly, and I'm gonna jack the screen from you.
Perfect. Todd, hopefully I didn't lose you there.
Oh. Yeah. All right. So cost segregation. I'm sure a lot of everybody's heard of cost segregation, especially this year. It's super popular service. Especially with what Josh is there talking about, creating those losses. When you're buying and building buildings, improving, how are you depreciating those assets? I've been doing this for a little over a decade. If you ask me what cost segregation was, 14 years ago, I probably had some basic understanding of depreciation 101, economics kind of stuff. But I've really developed a passion for this type of service, providing it to our real estate professionals. And anybody that owns real estate, really, it doesn't really have to be just a real estate professional. Anybody that buys and builds and expands and improves, can take advantage of this this type of service. So what is cost segregation? It's when a commercial or residential property is placed in service. Generally the method of depreciation would be 39 years or 27 and a half years. What a cost segregation does is it goes in and says, hey, not all of those assets should be depreciated over those lives. You have personal property, you have land improvements, you have your building components, and you have land. Cost segregation goes through those and breaks those assets out, whether it's an acquisition or new construction or improvements. Each of those have different processes and different approaches. With new construction, a lot of the comments I get is, a lot of those costs are broken down. And absolutely, maybe full-blown cost segregation, it doesn't need to be, conducted on that property. Maybe it's just a high-level conversation with, somebody that's familiar with cost segregation to help you, guide you through how to depreciate those assets. So with that, you get these shorter recovery periods, 5, 7, or 15. And that's really the goal of the cost seg, right, is to take it out of those 39 years and 27 and a half years. The other maybe less known, conversation that's had with these cost segregation studies is, you're setting up a framework for your depreciation too. Typically, as I was pointing out, you have one line item on your depreciation, 39 years, $1 million. The cost seg goes through and breaks out all the assets, from the foundation to the roof, windows, walls, everything inside of it. And, not only are we trying to, accelerate those assets, but setting up that framework for future dispositions or future improvements. That can be really valuable, especially with acquisition settings, and getting that framework set up. You're going to replace a roof, a few years later, having that basis for that roof on your depreciation to be able to expense later on, could be really valuable. And maybe that's something, that's kind of overlooked with a cost seg. Benefits of property, we've kind of just talked about, accelerating depreciation, deferring income tax, increasing cash flow. Those are some of the basics, expensing, capitalization. That's kind of that setting up that framework again. But maybe some of the less, common ones talked about is reducing real estate property taxes. Sometimes their studies can be used in that aspect. Reducing insurance premiums. We've had our studies used in that fashion. Basically, when we're coming up with values, we're coming up with a replacement cost new, for that acquisition. So you have those values, very similar to what an insurance company would come in and do. The other one is transfer tax. Depending on your area, transfer tax could be, big. If it's Cook County, we do a lot of stuff that's, where we're killing, two birds with one stone. You conduct the cost segregation study for federal tax purposes, but then you're also, looking at what the personal property is related to that building. And I have an example kind of going through this to kind of show you what that may look like. Again, my background, I'm an architect by education. Most of my team is construction background, engineers, and that's because we're breaking out this building into all of these components. So having that knowledge of how it's constructed and all of those assets, that's really where the expertise matters. A lot of the top cost seg firms and top CPA firms that have cost seg departments, typically utilize, construction background. We need to be experts in one area of tax, and that's depreciation. I fall back onto Josh Graham and Dannielle here, for more of the technical tax issues. But I need to know how that bill is broken down and how to maximize depreciation for our clients. So that's where the expertise matters. Definitely, a typical CPA is not going to know how to value, an acquisition, breaking it down from that foundation to that. And then understanding the tax laws, being through audits, understanding and, being aware what the IRS is actually looking at when they're looking at these studies. And a lot of times it's just, not being aggressive, having a methodology and understanding of their depreciation guide. Josh and Jim and Dannielle, if you guys, have any, you guys think I'm missing anything?
Yeah, one thing I guess quickly to add, I think generally we think of cost segs, think of newly acquired buildings, but it doesn't necessarily have to be that way, right, Steve? We can do a cost seg on something that was acquired a few years ago or even more.
Yeah, definitely, and I kind of talk about it a little bit later here, but yeah, definitely, it could be, there's a lot of strategy around that. It could be, maybe you don't do it in the year that it's in service. Maybe you just don't need that accelerated depreciation. You could do it a year or two later, kind of poker chip it around. And we do have clients that do that. Maybe you bought 4 or 5 buildings this year, and you do one study this year, and then study next year. That's really part of the important process of sitting down and talking with a cost seg expert, and then your CPA as well. Getting everybody involved to understand your tax situation and how best to utilize these studies.
Yeah, and I think just FYI, if there was a service, or if there was a building that was acquired, we'll just say it was 17, and you wanted to take that depreciation now, you'd have to make a method change on your current tax return. There's some extra forms that need to be filed, but then you're essentially claiming all of the catch-up depreciation now, and with the way that the NOL's rules change, it still would qualify as an NOL in 2020 if you did this on your 2020 return, and which can then be carried back or forward, as we were talking about earlier. So there definitely are some strategies out there for both newly acquired and also previously acquired buildings.
Definitely.
If I just might add for a sec that, yeah, you don't need to do them all at once. What, Steve and Josh said, what we try to do is parse them out from year to year to manage our clients' tax liability as close to zero as possible, or to generate the losses, especially now with the CARES Act, that we can go back and get these refunds. And we also do a cost seg. You're able to do them on a 1031, provided that you go up in value. We often do cost segs on those type of transactions as well. So, all right, just wanted to throw that in there.
Definitely. And then the approach, to the cost segregation, isn't overly complicated either, especially with an acquisition. Typically, we require, a closing statement, appraisal, if there was one done. And then we go on property, physically inspect the property and break down that building. Construction, it gets a little bit more complicated, with gathering information from the general contractor or whoever you're subbing out for the work, and then balancing and reconciling back. But, overall, the process is pretty streamlined. We gather all the information that's it's for the cost information, specifications, blueprints, things like that. Any reputable, cost segregation firm is going to go through these steps. And usually takes, between 3-4 weeks to conduct this process. So Tax Cuts and Jobs Acts, there were some big changes back in 2017, that impacted, cost segregation. Typically, it was bonus depreciation. I think, Josh kind of touched on it a little bit. Bonus depreciation went from 50% to 100%. That was huge. So anything 20 years or shorter, you can basically, write off all year one. So anything we move into a shorter life from 20 years and shorter, it's going to go on zero basis that year. The other big one was acquired property. Before this, you were able to take bonus on acquired property. So if you acquired, an office building or a rental property, you would have to depreciate those assets over 30 or 39 years or 27.5 years, 15, 7 or 5 years without taking bonus. With the changes in 2017, you're able to take bonus, which has been huge. The other thing was qualified improvement property. I know Josh again kind of touched a little bit on this. What happened in 2017? We had a lot of different. We had qualified leasehold improvements, qualified restaurant improvements, qualified retail improvements, and they all had different rules and different things. The way they classified. What they were trying to do is combine them into one, and that was qualified improvement property. And I'm going to touch on that a little bit more in the next slide here. CARES Act and cost segregation. So with qualified improvement property, the intention was to be 15 years, 100% bonus back in 2017. There was an error made where it was classified as 39 years, which made it ineligible for bonus. With the CARES Act, they came back and corrected it. The really big intent for the qualified improvement property is looking for properties that are getting improved constantly, maybe hotels, restaurants, even dealerships where they're improving those properties constantly, over 5-10 years, because what qualified improvement property does is classifies assets as 15 years, 100% bonus. And what it looks at is interior improvements to the property, non-structural. So, anything that's you're doing interior improvements to, it could potentially be qualified improvement property. 15 years, 100% bonus written off year one. The other big change with the CARES Act was the ML rules. Josh kind of was talking about before I jumped on. Josh, you got anything to add? Do you have anything to add to that?
No, I would just say, I know we have a couple other topics after this to potentially cover. So probably just make sure that you're able to cover the energy credit stuff too. It's good stuff.
I'm getting to it. What types of properties qualify? Cost seg has gone a long way. 10 years ago, maybe you were looking at $1 million plus for a property, bigger properties and stuff that you're, larger projects. Nowadays, most cost seg firms are capable of doing, smaller single family rental properties. So I almost just say, if you acquired something or you're doing improvements, you're building something, talk to your CPA, talk to a cost seg expert. We're going to evaluate and see what the actual value and benefit is. Again, I mentioned it, maybe it doesn't require a full cost segregation study. Maybe it's just consulting, high-level consulting on how to actually structure those assets. Again, how much does cost seg cost? Fees range all over the place. But typically you see $2,000 to $20,000. We don't charge contingent at Wipfli. Most firms don't. I would step away from firms that would charge contingent based on the benefit they're providing. The IRS specifically states that, that they do not scrutinize studies that perform under contingent fee basis. So, with that, our fees are usually generated based on, building size, how complicated, example would be, a retail strip. If you have a single tenant, maybe Kohl's in there, that's a lot easier for us to break down for depreciation purpose versus if you had a multi-tenant where it's 15 tenants in there, because we're going to break out each tenant for you, again, for that structuring, that framework for disposition purposes. So that's more work, more time, more material put into the study. And it could be the same price point, same value. It doesn't matter. It really comes down to that time and material it takes us to generate the study. So I have a few example studies here that we did. I wanted to throw a single family rental property in here. This was a $375,000 acquisition of a single family rental property. We conducted a study on it. In the year one additional deduction that the client ended up receiving was $88,000 on that single property. In the year one after tax, net present value was $33,000. So he could have paid $2,000 for the study and got over a 10-to-1 payback on the study. Here's a transfer tax study that we did. This was a $10 million acquisition on a 100,000 square foot industrial building. With this one, it was really unique. It came with a lot of personal property that you would think more what personal property would be is, craneways, boiler systems, things like that. And what we did is we ended up getting in there before they acquired it, breaking down all those assets, and ended up saving up the transfer tax of almost $16,000, plus providing them the study that they needed for their federal tax purposes and getting them a deduction of $2.7 million. And just that transfer tax alone was more than what they paid for the study. So, that's a good example of, getting ahead of the curve and, having a conversation with a cost seg expert or your CPA to see if there are strategies. Here's something that maybe, cost seg, the industry doesn't talk about, as much either, is that tax engineering portion of it. You can get involved before a project is breaking ground and strategize on, how are those assets going to be broken out in the pay application? How is the GC going to break those assets out? How are they going to be structured? Example, panel boards for electrical. Instead of mixing all electrical, for the equipment with the lighting and HVAC for people comfort, having separate panel boards. And in this scenario, we got involved well ahead of time, and we were able to help that client, structure the depreciation through the construction process, and that maximized the depreciation, right? Those are very unique situations because in this scenario is a pharmaceutical facility, so it's very special purpose, a lot of special purpose assets involved with it. Here, we do a lot of fixed asset reviews. This client that never had cost seg studies done. We went through all their depreciation, ended up conducting 72 studies. We found $8 million of assets that what I refer to as ghost assets that are no longer there, sold, replaced, who knows, moved, and we retired those. We moved to over $100 million of shorter life assets, with them being a food manufacturer that had a lot of special purpose stuff. They're just misclassifying. Really, what happened there was, they just had a turnover rate of their internal accounting people, and they just didn't have experience on how to classify assets, and their accounting firm really wasn't tracking them either. So we ended up coming in and correcting it all, and with them being a Fortune 100 company, we almost, with $26 million after tax net present value, almost completely shield all their income for that year. So section 179D.
Steve, real quick, do you think you can go through both 179D and 45L in like 3 minutes?
Yeah, let's do it.
Cool.
So I'll just skip kind of through the section 179D is an energy-based tax incentive that's available for reduction of energy and power costs to commercial and certain residential buildings. 179D tax specifically applies to those buildings that notably reduce interior lighting costs, as well as heating, cooling, and building envelope. So those are the three components that we're looking at for those buildings. The lighting, the envelope, and the heating cooling system. The buildings can partially qualify for 60 cents for the HVAC, 60 cents for the envelope, or 60 cents for the lighting. If it reduces energy by 50% or more by any of those components combined, it can get $1.80 per square foot. So if you have a 100,000 square foot building, you potentially get a 100,000 square or $180,000 deduction. We usually package these type of certifications with cost seg. You know, if you're building a building, you know, typically this energy credit, we're collecting the same data. We usually roll those in as one study. As of right now, it has not been extended past 2020. We anticipate it will, but you know, as some of the other panelists have talked about with elections and how Washington is right now, we just don't know when that is. It needs to get tagged onto a bigger bill, but we anticipate at some point. So then there's also what we refer to as Section 45L energy credit, and maybe this is one that's maybe not talked about as much either. Is that's a credit, $2,000 credit per unit or per single family that a builder or developer builds. Basically just have the basis in the building of it, and $1,000 credit per manufactured home. So if it's a manufactured home, you can only get $1,000 credit. This again is very similar to 170ID. It looks at how the energy is reduced for that unit or home. And some of the components that we're looking at for that is, you know, the HVAC system, you know, the lighting, the U factors for the windows, the insulation of R-rated factors, the overall building envelope, you know, how is it oriented? Is it south facing, north facing? So to do these studies, we have to certify each type of units. If you have 100 units, we have to look at each and model each unit to see if it reduces energy by 50% or more. And then certify those. But then you're potentially, you know, if you have 100 units, they all qualify. You know, it's a $200,000 tax credit. So a lot of value there. And these are specifically only for residential properties, 3 stories or less. I should add.
And Steve, I'm just gonna jump in real quick. Yeah, it's all residential, 3 stories or less. It's either if they were sold in the year or first rented that year. And it's a credit, it's not a deduction. So it's much more valuable than the 179D deduction because you're actually getting a dollar for dollar credit under tax liability.
Right.
So if anyone has more questions, we have a lot of clients that have been taking advantage of this. So definitely reach out to us. I know we're running low on time, and Dannielle go ahead.
Yeah, let me conclude just with some remarks. You know, these are, you know, if you're building and buying, you should explore all these options. You know, it's usually free to review them, talk to your CPA, talk to a cost seg or any expert that's conducting these energy incentives, and see if they actually provide value to you. I mean, there's a lot of different variables based on each and everybody's situation, but usually sit down and have those conversations. You know, they'll give you, you know, insight on whether it's valuable to you, and then talk to your CPA and how it's going to impact your tax situation.
Awesome, thank you.
All right, go ahead. Yep.
I think I know we only have a few minutes left, and I think Dannielle wanted to share some thoughts on a tax outlook.
Mm-hmm. Yeah, thanks, Josh. So I'll kind of go quick here, but I think if anything, 2020 has taught us that patience is a very big virtue for us all to have, because I think a lot of people were really expecting this sort of relief after the election was over, and kind of knowing what to think about as far as tax reform or whatever for the next 4 years. And because of like the Georgia runoff, Senate elections and everything, we're still kind of in limbo until January. So a lot of, you know, what we're looking at and thinking about is still largely speculative, knowing where the House is at, but not knowing where the Senate is at. And also really just knowing, I think the last panel kind of touched on it, what's really going to be priority under the Biden administration as well is kind of key. So kind of high level, what we're looking at under Biden's plan is really an increase to corporate tax rates, also an increase for, you know, people whose income is above that $400,000 threshold told, which is probably a lot of clients and a lot of people on this call. So it can be definitely very impactful, to people going forward. I think kind of our really communication with a lot of our clients has really been to kind of just keep going with what we know now, and don't hedge our bets on what's going to change in the future, because we don't know how the tax law changes. And generally speaking, we kind of always end up almost in the same sort of spot, administration through administration. Kind of speaking to a few things the last panel talked about, 1031 is kind of a huge topic that they've talked about reform for, and kind of cutting it off for those whose income was over that 400,000. I strongly agree with that panel, and Jim, and I think Josh's comments as well at the panel at the beginning. Statistically, if we look at the data analytics for 1031s, it would only cost more money to actually really repeal like-kind exchanges. I think typically they generally generate way more tax under most plans, because people aren't holding them until they die, and getting that step up in basis is generally what we've seen through the program. Additionally, a few other changes that we may see are around opportunity zones. I think generally speaking, Biden is very supportive of opportunity zones. The program itself has received bipartisan support from the very beginning. What we may see different things on is perhaps more reporting requirements around that, which can be helpful, from a data analytics standpoint, but obviously the more we're adding to them, the more onerous they become. So hoping that anything that they add in isn't too much extra work for the funds to sort of manage. But really the big thing around, if we're thinking about opportunity zones and that sort of investment, is really what the capital gains tax rate is going to be in 2026, when those who have already deferred their capital gains actually go to pay the tax. So it'll be interesting to see perhaps what comes out of that, and what is currently the plan. I think under what he has on his website and everything is the capital gains tax rate is planned to be around 39.6%. So much higher than the current 20% tax rate now. But otherwise, I think the summary of this webinar was really, to kind of meet with your CPA, and this is kind of the prime time as it's year end. I think we often get a lot of people adverse to both cost segs or maybe 179D studies, because either the cost or they're afraid of the recapture on it when they eventually go to sell the property. And those are kind of all big calculations that we're kind of happy to work through. It's, hey, does this make sense to do this now, or should we wait? But I think with the CARES Act, most of the time, being able to do that NOL carryback, it is generally a really great tax move now. So I think those are my kind of speed closing remarks here. Do you guys have anything else to add?
No, Dannielle, no, I think that's right. I mean, we're really busy with our clients right now, going through with them, trying to go back and get some, create NOLs, go back and get some tax refund money. So I think that's very wise counsel. If anybody would like our slides, please let the Real Estate Journal know. Pass along your email address, send it to them, and we would be more than happy to send you our slide deck. So Todd, thank you very much. I think we're done.